So I request everyone to please be seated because we'll be starting with the sessions. I hope everyone has enjoyed their lunch and all set for the next sessions for the day. So let's proceed to our next panel discussion where the panelists will share their insights on how Indian family offices are redefining the startup ecosystem. And this session will be moderated by Mr. Karan Mohla, the partner and executive director of IDG Ventures India. So may I please request you to come on the stage. Mr. Karan Mohla is the Executive Director and Head of Consumer Media and Technology Sector at IDG Ventures India Advisors, where he heads the sector focus and strategy on consumer media and technology investments. He has been investing in Indian companies since 2009 and has over 12 years of experience in the technology industry across India and the US. He holds a bachelor's degree in business administration from the Ross School of Business, University of Michigan, where he was the youngest graduate in the program's history. And now may I request Mr. Anurag Seth to please come on the stage. Mr. Anurag Seth is a director and head of global wealth management at Quant. He has 14 years of experience in private banking and wealth management businesses. Prior to joining Quant Capital, he had an 11-year stint with Standard Chartered Bank as the business head of wealth advisory at SCB India, focusing on managing and building the business for high net worth individuals and corporate clients. During his tenure, the bank was awarded the Best Financial Advisor Award and the Best Structured Product Award by Structured Product Magazine Asia. And the Best Financial Advisor Award was by CNBC TV 18. The total AUM during his tenure hit an all-time high as US dollars 3 billion. Now please welcome our next panelist, Mr. Anirudh Damani, the managing partner of Artha Venture Fund. Sir, can we please have you on the stage? So he is an active angel investor and he has made 57 startup investments since 2012. Mr. Damani is an advisory board member of Venture Catalyst. He is a founder of Artha India Ventures, founder of Artha Energy Resources, and has a double major from Austin College at Texas in business administration and economics. Mr. Damani has been an angel investor in India since 2011, prior to which he was an entrepreneur in the energy sector in the US and in India. Some of the key winners in his portfolio include Oyo Rooms, Now Flows, Exotel, Tala, Purple, Coatloot, and Lending Club. Mr. Damani's investment philosophy says, invest early, deploy funding in tranches, don't throw good money behind money that is lost. Invest in execution over idea and control the burn until the startup has a clear plan to achieve positive unit economics. Now let's welcome our next panelist, Mr. Sumit Dhanuka, the founder and managing partner of Precog Innovation Partners. So can we please have you on the stage? Mr. Sumit Dhanuka, the founder and managing partner of Precog Innovation Partners, has spent over a decade in the Indian financial sector across private equity, venture capital, M&A, and across the Indian innovation and entrepreneurial ecosystem. As a founder and managing partner of Precog Innovation Partners, he is building an innovations acceleration platform to nurture, accelerate, and invest into disruptive technology and business model innovations in smart mobility and clean transportation for the Indian market. He also serves as the venture investment advisor for strategic investments for the SAR Group Family Office in Gurgaon. He is a qualified chartered management accountant from CIMA at UK and a qualified company secretary from the Institute of Company Secretaries of India. So I hope everyone is not sleepy. Can we just have a round of big applause so that we just wake up and, yeah, thank you so much. May I please continue with the session?
Thank you. Sorry, can you hear me? Thank you. It's always good to have the first panel after lunch. So we'll try and keep this somewhat interesting and engaging. We have a very interesting mix of folks on the panel here. And I think the key theme around what we want to try and get into here is around how family offices have evolved, how we've seen their strategies change, and I guess our respective involvement with family offices. Maybe just to start off, I'll share our experience very quickly and then would love to talk about some of the experiences of the fellow panelists. So we have about 50 plus family offices who've invested in the IDG funds over the last 5 years, largely focusing on early stage in venture opportunities in technology. And a lot of interest comes from surprising areas such as people who build businesses in manufacturing, in really what used to be called the old economy, but the stable economy. And we're seeing more and more interest from that. And I think the AIF regime has helped catalyze that interest a lot more. So I think the first question, which I'd love to just ask the folks on the panel is, how have you seen the evolvement of family office investing in the last 5-6 years? And I think with the AIF regime and regulation that's come about, has that helped catalyze, and in what way in your experiences?
Okay. I think.
Yeah, please.
So since we come from multi-family office, we have been dealing with clients who have been running businesses. Initially, when the family office culture started, and most of the client investments were in an area of operation they were already been doing it. So if someone is coming from a pharma background, so he wanted to do something within the same industry because he understands all that. Lately, what we have seen in last couple of years is these are the same set of investors who are now diversifying into other businesses. They want something on technology, they want something on unrelated or uncharted, specifically looking for that disruption theme in a particular sector. So that is how it has transitioned from being a sector specific to now a complete generalized version in terms of what they think according to them will make value going forward. So that has been the transition within the client set that we deal in.
So, just to add to that, when I came back from the US, I'm the eldest of my generation, and the generation before us got into wealth. They actually built most of the wealth, but it happened in a haphazard manner, right? So there wasn't really any strategy behind what we're going to do with the wealth. Apparently, all the wealth just kept getting reinvested into the business, and as long as the business kept churning out above market IRRs, it was all good. Then when it looked like the businesses would start probably underperforming the market, we got into real estate in '98. Then real estate was doing well, so then we got into hospitality. And hospitality was doing well, so we got into more real estate. And then it's sort of like by the time I was back from the US, I felt like my family was doing a ton of things, but there was actually no real strategy behind where the money was getting invested. It just seemed that money would come out of one hand and go to another hand. And then as soon as that would throw out some more money, it would go to some other hand. And then there was just one guy who was sitting in the office figuring out from which liquid fund to pull out money, where to put the money, things like that. But so when I came in, I didn't really want to get into the mess because it sort of worked. So it didn't make sense to join and screw up things with my way of putting management techniques into it. So I decided to take some money out of the family business. And I said, why don't you let me build a portfolio? It took some time. It wasn't as easy as it sounds because my family didn't really believe in startups in 2010, 11 when I was back. But they gave me some money, but they said, we don't want you to have a chunk of money and then go out there and blow it all up. So why don't you tell us how you're going to ensure that the capital is always preserved. We're okay with if you don't make returns. So then the idea came up that, why don't we invest money into a renewable energy asset? Because a renewable energy asset by design does not depreciate till the last 10 years. Right? So it's a 25-year asset for the first 15 years does not depreciate. So technically your asset or your principal is always at 1x for the first 15 years. The only thing that is at risk is the actual return. So we did that. I went out, bought a windmill, took the returns. Obviously now I didn't have that much money, returns were small. I invested that into startups, but all of that by design led to a proper strategy, which now I think my family is starting to understand. And all other businesses are starting to become a lot more structured because now we have an operating business, which is the windmill, that throws out cash from which we invest into startups. When we exit from the startups, we have more capital to put back into windmills, create more operating cash flow, and it sort of becomes a self-sustaining ecosystem. So yes, I think we didn't really have a word for this back then. I in fact just coined the name Artha India Ventures, that's what I'm going to call myself. It was much later, I think a couple of years back, where the whole word family offices started to do the round, right? Nobody said family offices 5 years ago. But now I think the way we built it, especially because I have now moved over from running the family office into an institutional fund and running the fund, I had to now get other family members onboarded, right? right? So now we developed a quasi-family council. It's not really called a council, but it is a quasi-family council. We decide on investments together. Thankfully, my uncle and father are also part of it. And I think over the next 2-3 years, we'll evolve into a proper family office. We're sort of in the middle of it. And I think most other people are in similar situations, right? I don't think everybody is a proper family office, leaving out the Burmans and people that have spent time doing it.
Sure. So I think, I think in my case, it's been a bit of a interesting journey primarily to kind of respond to your question, Karan. As in, I was fortunate to kind of get along with one of the successful entrepreneurs who had built in a large business over the last 25 years and exited from there, created liquidity. And incidentally, I was one of the early members to have got together with him for the next innings of his life. So I would think that it is more a contrarian approach to how all the other families who have operating businesses in place would look at the approach to the family office structure. So I think there was a lot of experimentation, as in which went in, where on one side it was to say that we have one set of competencies as a group, which is around understanding B2C businesses, what it takes to build brands in India, which is brand distribution, go-to-market channels, after-sales infrastructure. And with that competency and capability which we have, what is it that we can create as new ventures from there? So which is around building on those competencies and entering into the next zone of businesses which are going to be ruling the next few decades. So it was a very, I would say very, on one side a very top-down approach to it, but on the other side, because everything was getting created from scratch, it was a very bottoms-up approach to how to go about building those ventures. So on one side there was build out of new ventures from scratch, which were operating companies, but on the other side, the hat which I was wearing in my earlier avatar before we started Precog was about co-creation, which was to say that we have strengths on taking technology products or ideas into mass market situations. How could we leverage what is happening in the ecosystem outside, which is product, technology and teams, and bring our capabilities of manufacturing, go-to-market, patient capital to kind of take those technologies and products to markets faster. And that's where, so we did a bunch of investments across India, US, Singapore, Israel, and they were all around the core focus of saying that we bring in our strengths, the early stage innovation ecosystem brings its own strength, and let us build it together. And that was one approach. The other one was where we were in unrelated sectors. We were going out and investing into a lot of venture funds as LPs and co-investing with them in their portfolio companies, because we said that we don't understand that, but we know that they are sunrise sectors. So it was a very, I would say all of it evolved over a period of time. There was a lot of experiments happening through the journey, and that led us to kind of then say that, if we have done co-creation with one family, why can't we do it with some of the large families in the country, to say that let co-creation be institutionalized. And that's what we are doing at Precog now. So we work with 15 odd countries today, which includes Israel, Southeast Asia, Canada, and the Nordics and the Europe. And we look at, not to say that India is excluded, but outside of India, we look at innovations coming in from these countries, primarily in the sectors which we understand, which is energy, environment, and infrastructure. So we are looking at technologies, innovations coming in from those nations and relevant for the Indian market, and work with some of these families as our partners in co-creation. So they would not just bring in capital, but they would also bring in what it will take to build those businesses into scale. So they would bring in manufacturing, go-to-market, after-sales infra, and all of it, because they've seen it and done that in the past. So that's my take on your question. Yeah.
So I think that's very interesting. So two things which I think are relevant to talk about a little bit more is around how family offices have gotten more professionalized, especially in the last couple of years, and maybe also talk a little bit about how family offices are looking at doing more direct investing, especially into areas which they understand and or which they are seeing as the next sunrise sectors. And just from our experience, when our first India fund was raised in 2013, there weren't any organized family offices, maybe barring one or two. And most that had exposure were also investors in angel funds like Mumbai Angels, Indian Angel Network, and so on. And I think what's changed now is a lot of the family offices are doing direct investing through platforms like Let's Venture, Venture Catalyst, AngelList, so on and so forth. But also the organization of the office itself, beyond obviously alternate assets, which is maybe 10-15% of their overall corpus, because the overall professionalization has happened in a much more comprehensive way. The way they look at risk, the way they try to manage risk is very different than 2-3 years back, 3-4 years back even, when most of these were a little bit of an unknown quantity. So, I guess on those two areas, what have been your guys' experience in terms of how organizations have set themselves up as formal family offices, and how do they look at direct investing versus investing through vehicles such as funds across assets, but maybe talking more about the alternate assets, private equity, venture, and let's say real estate?
I think there's a lot of evolvement that has happened on family offices in the last couple of years. But the prime case I have seen on family offices, they still prefer going through direct investments rather than doing under a fund structure. And that is because they want an excess for something that they are investing in. And they are very sure on what idea. So they don't want a combination of ideas coming to them and they're investing into. So risk diversification, the only thing you play through an AIF route or through funds is a risk diversification, which they are anyway playing through a portfolio of companies they are investing in. So to that extent, I think they always would prefer, that is my interaction with family offices, they always prefer to go direct rather than taking a fund route to invest.
So I just had to recently answer this question. We did our first close in July, and most of the investors were family offices. In fact, and a lot of them were already active in the angel space, but what really helped was that we first of all brought a very differentiated strategy. And since I had been investing my personal capital for the last 6-7 years, I had a track record to show that we've done well with the strategy that we're executing. But again, the question was, why do I need you when I can do it myself? And the question that we had to answer then was, early stage investing is not for everybody. It requires a great deal of handholding. I don't think a person who's running an operating business has that kind of time available to really handhold a startup. In fact, before this panel, I had a startup not even invested in, who was sitting back there, and we were trying to work out even on his business deck at this point, right? To be able to provide that kind of time, you need to be a professional. And we were able to convince them, and also we offered them the opportunity that since we're going to invest up to Series A, we can actually bring you about 10 to 15 deals over the next 3 to 4 years that are going to be prepared and ready, where you don't have to go out there and for the lack of a better word, like wipe their bottoms and make sure that they're all clean, because we're going to take care of that for the first 3.5-4 years. And which is why you're paying us a little bit of management fee so that we can do that. And it really worked well. Obviously it also helps that Madhusudanji Kela is a co-GP on the fund, but family offices really gravitated towards that. Not only do I get to participate early on, but I also have the opportunity to co-invest in future rounds. And that really worked out well for us. I mean, we finished raising our first close target in less than 2 months, so which is pretty good.
Yeah, so I think it's very relative in terms of how the approach works, because I think it all depends on the evolution where or the learning curve where the family is, because in many cases, and we work with a bunch of families now on our co-creation stuff, what we see is, many of them are willing to put in that extra bit beyond their existing operating teams to say that. So incidentally, we are now asked to say that, can you put out our innovation setup altogether? Because we understand that there's a fear of missing out. So therefore, we understand that we can't afford to miss out after seeing the sharing models and after seeing e-commerce and some of the other disruptors evolve, because I think only now we are able to see some tangible outcomes of what we were talking about as startups 5-7 years back. right? And when a Flipkart, irrespective of whether it's listed or not, when a Flipkart is more than the summation of the entire offline retail industry, as in, and you know, getting sold to a large player, that kind of raises eyebrows, and that's when these families start to realize that there is need for that professionalization and need for separation of the promoter wealth from the you know, treasury of their corporates, right? And I think that is where, and the second part to it is the direct or indirect. So I think on the direct indirect, again, it is a matter of you know, how serious the families are. So some of the families we are working, as I said, you know, are open to saying that, can we build this team who can actually just focus on looking at the new age disruptors who can disrupt our industry. So how can we embrace those innovations ahead of time? Whereas some of the others who are saying that we are good in terms of the growth in which, you know, in their own comfort zones, they would say that we are more open to following this up in an indirect approach to start with, and walk in that journey of investing into funds, co-investing with them, and then possibly, you know, in the next 2-3 years, get into doing it on our own. So I think it's a very gradual approach, and it's a lot of dependence on where I stand in my life cycle of evolution as a family.
Yeah, and actually that's, I think you guys have covered all the points which we've seen in our interactions with our LPs and potential people, which is, you know, it started with a little bit of, or in some cases a lot of skepticism in 2013. It wasn't even the best of times to go fundraising. That's gradually and very, very gradually turned into a lot of optimism. And it's helped by, you know, a situation like a Flipkart, where, you know, we were fortunate to be investors a long time back, and when the exit happened, we got unexpectedly a lot of calls back from our investors saying, oh, I just got some return from this Flipkart, I didn't even know we were investors. So, you know, there has been a shift, and Flipkart was probably the end result of a lot of what happened. But through the last couple of years, what we've seen is, because of the number of exits that have taken place in venture-backed companies and PE-backed companies, in IPOs, M&As, the number of returns that have happened, in overall terms may not compare to public markets still, but it's growing, and there is a democratic shift towards how that will happen over the next few years. So, you know, in terms of how family offices, to the point that you guys raised, how they look at, you know, co-investing, for instance. Should family offices look at co-investing very early on with funds at the time of entry? Or is it better for them to wait till some of the companies are more mature, where some of that risk has been taken out because you're already participating through it directly, so indirectly by investing in the fund? So just around how maybe family offices can think about co-investing. And the second is the question I think all of us get is, how do your returns, how do private returns compare to public market? And how should family offices look at them either together, or how should they look at them differently? Because that's always a question about capital allocation.
I think I'll cover on the capital allocation, because that is what I understand. Rest, these two are the experts there. I think returns, you can't compare returns from what you get here and to what you get on other investment avenues. So I don't think so. The teams that are managing, so he covered a point which says promoters have now realized it is important to keep a promoter wealth separate from a treasury wealth. Earlier, when we used to approach promoters, the only thing they used to say, my CFO is handling it, please talk to the CFO, whatever he deems fit, he will tell you what exactly to be done. So a brief description would have been given in terms of, and the only description that we always used to get from CFO was, he doesn't want to lose capital. So obviously then all other windows are shut. Then the only thing is, it is going exactly in the line of what a treasury management would be. It's the same what a promoter management. Today, I think a lot of promoters are okay to take risk. Risk in terms of diversification into other asset classes. So there are a lot of investors, promoters who are talking about getting into equity. There are a lot of promoters who want to get into venture funding, startup funding. So I think that is the risk, you know, that is how the movement has happened in terms of, and they understand the risk, and they know what is the return differential can be. So you can't pluck it under one roof and say, you know, these are two investments, one will give you a 20% IRR kind of thing, another will give you a, so that kind of conversations have stopped happening in terms of whether this will give me more than equity, or whether this class of private venture funding would give me a higher. So returns, till the time there is a conviction on an idea, returns come on the second stage. but I think the conviction on the idea becomes more important.
So, I mean, I think that pretty much covered the second answer. But let me go back and say, on the first question, when should family offices look at coming into investments or co-investments with venture funds? I think it really depends. If they want to come in early, it should be in a sphere where they have the relevant experience and they can be helpful to the company. They shouldn't be passive investors early into a startup, because that's exactly what they have the venture fund for, right? But if it's a company, for example, let's say it's in the FMCG sector and you've got, for example, the Berman family office in your LP table, I would love for them to come in early, because they can provide a lot of the help and a lot of the build out that nobody else could, but if it was, let's say, a venture that had nothing to do with what another family office is doing and they want to come in early, it's a tough situation, but I would prefer them not to be there, because they would just double up their passive exposure into a startup, right? So yes, but I definitely would love for more family offices to come in towards Series A. I think Series A is a perennial problem in India, especially if you compare us to the US market, where most Series A's are actually done by angel investors. There's not a lot of funds who do Series A's. Then in terms of asset allocation, which was your second question, I have had to answer the same question. We come from a family of stockbrokers. If my father's portfolio has been growing, pretty well over the past 20-25 years, and apparently everybody in my family is a great investor, right? So I obviously have to answer that question time and time again. The biggest question being liquidity, right? So I can show amazing X's. They're like, can you sell this and get me the cash? And then obviously they said, I can sell Falana stock tomorrow and I'll have cash in my bank account. So how do you answer that question? So I always come back and say, you have to have a diversification of your allocation, right? You can't just be lopsided completely into, fixed income. Neither can you be completely lopsided into all equity, but you have to leave some amount of money for this asset class, which is doing fantastically well across the world, right? There are very few places in the world where it's not done well, India being one of them. But it's improving, like you said. So I always tell them, listen, if you have 100 rupees, which constitutes your entire portfolio, you got to put at least 5 rupees in here, right? So I was at the same event in Bombay, and Atul Nishar ji was right before us. And one of the best things he said was, the worst investment you could make is fixed deposit, right? Because no matter what you do, you'll never beat inflation, right? And you have to look at equity. And even in equity, you have to look at diversification. It cannot be all ETFs, it cannot be all index funds, it cannot be all individual stocks. It has to be a bouquet, right? And then when you diversify that risk, you'll have some parts of your portfolio that are going to do fantastically well, and hopefully some of that will be in the venture space, but you'll also have some part of your portfolio that is not going to do well, right? And when you look at it as a whole, that's when you can decide whether you've made a proper allocation of your resources, and not just should I do a lot of startups and not do anything here, or the other way.
Yeah, so I think to just add to some of the thoughts which Anirudh shared, I think in the space in which we are, which is primarily focused on energy, environment and infrastructure, those are tangible sectors, hard tangible sectors, and we don't see a lot of, or rather we averged ourselves from going in and doing a VC fund around it, primarily because we felt that the gestation periods required to build those businesses out are much longer than the tenure of a VC fund life. So, and then hence we work with these families to kind of come in as early investors. Now, I'll share one of the very realistic situations which we are on in a couple of situations now, where these families are coming in as Series A participants. Now, because their teams have always looked at public markets, market numbers and EBITDA multiples and historical numbers, etc., etc. The moment the financials of this early stage company is looked at, the questions regarding all those structured financial ratios, blah, 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 keep coming up, which is to say that they are in their very early stage of understanding how this piece operates. And that's where I think, I don't think it's impossible, but I think it'll take some time for matured businesses to look at direct investing or even co-investing. Because it'll take, they'll have to kind of walk a path which is outside of their comfort zone to kind of take a step outside and say that we have to allocate time, effort, capital to build competencies to look at co-investments. Investing into a fund as an LP requires very different skills from looking at a co-investment, because then you are almost stepping into the shoes of the fund manager who is looking at an investment opportunity, right? So I would think that it's happening, but I think it's going to take a lot of time, and that's where AIF fund managers can play a great role in kind of helping those families who are LPs on the fund to walk that journey of transition, and helping, because at the end of it, that those families have deep capital. So they are not just potential exit partners, but also can walk that journey during the venture raising capital through the life cycle. That's one. On the capital allocation piece, I think it's a very measured approach, and we have now more than 2 to 3 dozen large wealth managers, so to say, who are good enough to kind of push what it requires to be pushed on how that capital allocation should be. So I think as alluded earlier, I think there is definitely the return aspect is not for those who have matured and walked that curve, the return expectation is definitely not at par with public markets, both because aspects of illiquidity, etc., are decently factored in, and also we see that it's appreciated that it's a very small percentage of the overall capital allocation. So therefore, the risk return is kind of factored in to say that we are willing to take that kind of ultra high risk on that X single digit percentage on the overall capital. And that's the capital which is finally getting into as LPs in the fund. So our push to families is that how can we kind of push the domestic capital participation in these funds, because otherwise it becomes really challenging to kind of have all the gains from some of the unicorns out of India as in getting out of India, right? So therefore that push is really, really critical. And I think even IVCA is working very closely with families to see that happen.
Yeah. So and just a quick question on that. Have you guys seen any either reluctancy or discomfort with the long tenure of PVC funds, which are typically 10 years? I know in some of your projects they would be even longer, but with fund life of 10 years, that's something which we've seen some level of discomfort, because A, it's illiquid, but B, it's illiquid for a long period of time. But is that more, once they're more comfortable with it, then that tends to go away, or is that actually a broader trend?
I think with client set that we manage, see, bulk of it, AIF investment started with all this real estate funds, where the tenure anyway was 7, 8, extending up to 10 years. And some of the exits haven't still happened in spite of they already being there for 10 years. So to that extent, people who have bitten that dust doesn't want to get caught into a wrong foot again. But obviously that part of business was different and this part of business is different. But overall structures remain the same. So to that extent, there is some reluctance in terms of when you go and pitch a 8-year or a 10-year. So certain sectors like what he operates in obviously looks at that tenure. So it always becomes difficult to pitch in and to actually realize clients have a 8-10 year visibility becomes a challenge. Other than if it's a drawdown structure where the client is comfortable and a certain amount of returns keep coming to them, but that also not a guaranteed kind of structure. So yes, I do feel that 8 to 10 years is a long time frame that per se for a client to look at that kind of visibility on the fund side.
So I think in our case, it really helped that our advisory board has Madhusudanji on it, who has obviously built a $28 billion AUM at Reliance Capital, and he helped a lot in terms of how do we ensure that some of these family offices do not get concerned about the long life, life of these funds, because ours is a 7 plus 1 plus 1. So the first thing we did was we decided that we're going to draw down the money over 4 years. And then we planned it out in a way that we would only require most of the money for follow-on investing. So the early outlays were much smaller. That helped families go, what, if you lose, you're going to lose small. When you win, you'll win big. That definitely helped. Secondly, we also made it very clear that we would not have any reinvestment period whatsoever. So even during the commitment period, if there is an exit, it gets paid out to the investor. So it gives them some liquidity. Third thing was that we showed them, gave them full access to our own investment information, right? So I've personally invested in about 60 startups. I've been part of almost 130 rounds. And we could show them this, and typically it takes, at least for us, it took us 4.5 years to return 1x of capital. And then everything else that remains is actually profit. So that gave a lot of comfort to them. They said, you know what, okay, it looks like at the max 5 years, 5.5 years, we at least get the capital back, right? Or part of the capital back, and then what's really left is the return, which they're again happy with not having, you know, everything back in 7 years. And I think unless and until we start having that kind of structures, at least as GPs today, and just to add to something what was said earlier, also having an open communication with the LPs. So I write probably a 1,000-word letter to my LPs every single month right now, because I think a lot of them need to get educated about this sector, and it really helps when I talk to them. They've mostly read through it, they've got some feedback. I share, you know, I share the deals that have gone to the last stage and then we lost them, or I share the deals that we've done. I share even what's going on in my personal portfolio, which obviously was there before I started the fund. And once they have that level of information, I think they're getting much more comfortable. A lot of them are also signing up, obviously, for second close. But unless and until we as GPs make that active effort, especially in such a young market like India, we're not going to get the kind of feedback or the kind of commitment we want from our LPs anytime in the near future. It requires that help.
Yeah, so I think just to add to this, I think, you know, the fact of life still remains that exits have been flimsy. They've been very, very small, very, very trivial, considered the kind of capital which has gone in and the numbers which have got, capital which has got returned by the AIFs or the erstwhile venture capital funds back to the investor. So I think that kind of definitely leads to a lot of skepticism, and obviously, you know, fund managers end up, you know, there's a lot of defensive approach to it, but at the end of it, those are hard realities. The other ground reality has also been, which has got witnessed in the last vintage of funds, in the last 10 to 15 years, is the fact that the teams which have gone out to start the fund, they have not stayed the fund life. Now, and we have seen many, as in there was an article last week in the Mint which talked about those smaller funds starting from the getting broken up and starting into the new ones. Now, you know, that kind of also raises questions to say that if the team which set out as an entrepreneurial team to run a venture fund where I have committed capital to, if that cannot stick along for the life of the fund, then what I'm putting my money into, right? So, which means that there are motivations which don't align for that tenure of the fund, and hence raises a lot of skepticism. So I think more than the tenure of the fund, I think skepticism and questions are with respect to also the motivations of the fund managers to kind of walk the fund life. And at the end of it, as we invest into ventures, same is the investment into venture funds, because the investment is into people. And it's because of the comfort of people that people invest. Tenure becomes secondary if that comfort is in place.
Great. I think we're out of time, but you know, if there is any questions, we'll be around. So feel free to just grab us. But thank you again. I think this has been a great discussion, very helpful. And thank you all for having the time for us. Having so many otherwise at home.